Today we are going to start the new topic, that is partnership final account. The topic name is Introduction to Partnership and Partnership Final Account. Now in 11th standard also we had seen final account. We had seen final account of a sole proprietor. Now when we were preparing a final account of a sole proprietor, there were so many limitations, such as a sole proprietor is having a limited capital, he is having limited managerial ability, his liability was unlimited, there was no stability, and specialization was absent. Hence, when a business is to be set up on a large scale, it needs more capital and involves more risk. So, two or more persons, whenever they come together and agree to share the capital, the management, the risk and profit of business, such mutual relationship based on agreement among these persons is termed as partnership. The persons who have entered into partnership are individually known as partners and collectively as a firm. Now let us see the meaning of partnership. Partnership is an organization where there is an association of two or more persons coming together to carry on a business with a view to share profit or losses of the firm. So whenever two or more persons come together to carry on a business and they mutually agree to share the profits and losses, it is called as a partnership. Now let us see the definition of partnership. It is as per Indian Partnership Act 1932 section 4, and it defines partnership as it is a relation between persons who have agreed to share profits of the business carried on by all or any one of them acting for all. So it is a relationship between two or more persons. Either the business will be carried by all, or if they agreed that one person should carry on the business on behalf of all. Now there are some features of partnership. Let us see the features of partnership. The first feature is agreement. Now this agreement are between the partners. Now this agreement may be in the written form or it may be in oral. Now generally a written agreement is preferred so that if there is an issues between the partners, it can act as a proof in the court of law. So whenever there is a written agreement between the partners, this agreement, written agreement, is known as partnership deed. The second feature of partnership firm is the number of partners. Minimum there should be 2 partners and maximum 50 partners as per Companies Act 2013. Third feature is lawful business, that is legal business. The partners should do only those business which is allowed by the state. If they are doing any illegal business, then the business will be shut down. The fourth feature is sharing of profits and losses. Now partners comes together, their main aim is to maximize the profit. Now partners always share profit and losses in the ratio which is given in the agreement. But if in the agreement it is not specified regarding the ratio, then the profit will be shared equally among the partners. The fifth feature is unlimited liabilities. Unlimited liability means if there is a loss in the business, then their personal property can also be used for paying the liabilities. The sixth feature is registration. Now registration of the firm is compulsory. Only in state of Maharashtra it is compulsory with effect from 1st April 2005. The seventh feature is joint ownership and management. Now all partners have equal rights in managing the firm. So all partners are jointly responsible for the management of the firm. The eighth feature is principal and agent. A partner always acts as a principal of the firm with outsiders, and with the partners they act as an agent. And the last feature is dissolution. A partnership firm can be dissolved through agreement between the partners. That is, if they mutually agreed, they can dissolve the firm, that is, they can close down the firm. The firm can also be dissolved if a partner dies or retires or becomes insolvent. Then also a firm can be dissolved. Now let us see the methods of capital account. Now capital is the amount invested by the partners in the business. Now there are two methods in which capital account is prepared. The first method is fixed capital method and the second is fluctuating capital method. Now what is fixed capital method? As the name suggests, the capital amount will remain fixed. Capital will not change. That is called as fixed capital method. That means the capital of the partner will remain same at the end of that financial year. There will be no addition or subtraction from capital during the year. Now whenever this fixed capital method is adopted, a partner opens a new account and that new account is called as partner's current account, and all the related adjustment of capital are solved in partner's current account, such as adjustments such as drawings, net profit or net loss, interest on capital, salary to partners or
Commission
salary to commission.
partner.
All this particular adjustment will be solved in partner's current account whenever a partner follows fixed capital method. In fixed capital method, the amount of capital will always remain fixed. There will be no change made in the capital account. All the adjustments related to partners will be solved in partner's current account. That was fixed capital method. Now the second method is fluctuating capital method. Fluctuating capital method means changing capital method. In this method, amount of capital balance changes every year. It changes every year because we are solving all the adjustments of partners in the capital account. Adjustments such as drawings, net profit, net loss, interest on capital, salary to partners or salary to commission to partners. All these adjustments we add or deduct in partners capital account. So there is a change in the balance of capital. So that is called as fluctuating capital method. Now after seeing the capital method, now let us see the various steps which are involved in accounting for preparing a final account. Now the first step in preparing a final account is we prepare a journal or subsidiary book. After preparing the journal, we post all the entries from journal to ledger. At the end of the year, we are doing the totaling of ledger and we are finding out the balance. Now this balance of ledger account is called as trial balance. So the next step is preparation of trial balance, and with the help of trial balance the partners prepare a final account. Now final account always consists of, that is parts of final account are, the first part is trading account, the second is profit and loss account, and the third part of final account is balance sheet. So while preparing this final balance sheet, it is always divided into three parts. That is, first is the trading account. Now let us see what is a trading account. A trading account is a nominal account. A trading account is opened to find out the gross profit or gross loss incurred during the year. Now let us see which are the accounts that we record in trading account. As we had already seen in 11th standard how a trading account is prepared, we will quickly go through this trading account. Now trading account is divided into two sides, that is debit and credit side. Now in trading account, generally on the debit side, these three account we have to write that will remain fixed, that is opening stock, to purchase less purchase return. Sometime instead of purchase return, it is given as return outward. So whatever is given in the trial balance, if purchase return is given, we have to write down purchase return. If it is given return outward, we have to write down as return outward. So opening stock amount will directly come in the outer column, purchase will be recorded in the inner column, and from purchase we have to deduct purchase return. On the credit side, sales will be always recorded first in the inner column, and from this sales we have to deduct the sales return. Sales return is also called as return inward, and after deducting sales return, the amount will come in the outer column. And the last account which comes on the credit side of trading account is closing capital. So generally these 6 accounts we have to always record in the trading account. That is 3 account on the debit side and 3 account on the credit side. Now on the debit side of trading account, we have to record all the direct expenses. Now what are direct expenses? Direct expenses are also called as factory expenses, or they are called as manufacturing expenses. Expenses which are used for manufacturing of goods are called as direct expenses. So all the direct expenses are recorded on the debit side, as you can see, that is wages, motive power, power and fuel, that is the electricity used in the factory, royalties, it is an commission. Then carriage or carriage inward, that is the transportation charges, custom duty, freight, import duty, manufacturing expenses. These are all direct expenses which are incurred while manufacturing the goods. After recording all the direct expenses, we have to do the total of trading account. Now if credit side total is higher of trading account, that means company sales are higher. So whenever sales are higher, a firm is going to earn a profit, and that profit will be called as a gross profit. So from sales we have to deduct all the cost of production that is given on the debit side of trading account. So whenever credit side total is higher, a firm is going to earn a profit, and that profit is gross profit. And if debit side total is higher, on debit side we have recorded all the cost of production. So if all the cost of production are higher and sales are less, then a firm is going to incur a loss, and that loss is a gross loss. So a trading account is prepared to find out the gross profit or gross loss of the business. Now let us see the second account, that is profit and loss account. A profit and loss account is also a nominal account. Profit and loss account is the main income statement. The actual profit or the loss of the business we come to know after preparing the profit or profit and loss of the business. It is prepared to find out the net profit or net loss of the business. So we are preparing trading account to find out the gross profit or gross loss of the business. A profit and loss account is prepared to find out the net profit or net loss of the business. Now what is net profit or net loss? Net profit comes after deducting all the indirect expenses and losses of the business. So the columns of profit and loss account will remain the same, just like your trading account. Now the first account which we have to record in the profit and loss account is the gross profit or gross loss which we have calculated in trading account. If it is a gross profit, in trading account we had recorded on the debit side. Now while bringing it down in profit and loss account, it will be transferred to the opposite side, that is credit side. And if it is a gross loss in trading account, so gross loss in trading account is recorded on the credit side. While writing in profit and loss account, while transferring in profit and loss account, it will come on the debit side. So if there is a gross profit, it will be recorded on the credit side of profit and loss account, and if there is a gross loss, it will be recorded on the debit side of profit and loss account. Now profit and loss account is prepared based on the rules of nominal account. On debit side, we have to record all the expenses and losses of the business, and on the credit side we have to record all the incomes and gains of the business. In profit and loss account we have to record all the indirect expenses and losses. Indirect expenses and losses are expenses and losses which are incurred in the office. While preparing trading account, we are recording all the direct expenses, but while preparing profit and loss account, we are recording all the indirect expenses, expenses which are incurred while selling and distributing the goods. They are called as indirect expenses. So remaining all the expenses which we have not recorded in trading account, will be recorded in the profit and loss account on the debit side. Expenses such as salaries, carriage outward, electricity, export duty, then few expenses which are recorded next are all those expenses which we were recording in last year analytical petty cash book. We were writing 6 expenses, that is postage, printing and stationery, traveling and conveyance, telephone, sundry expense. Sundry expense is also called as general expense. It is also called as office expense, or it is called as miscellaneous expense. It is also called as trade expense. So all these expenses we were recording in last year. The topic name was analytical petty cash book. These are all indirect expenses. Then further few expenses are there, such as insurance, advertisement, interest, rent, commission, discount, repairs. Then loss is given, that is loss by fire, audit fees, tax, legal charges, warehouse rent. These are all indirect expenses and losses. On the credit side of profit and loss account, we have to record all the indirect incomes and gains. Now, indirect income and gains such as amount received, that is interest received, rent received, commission received, discount received or discount earned, dividend received, and sundry income. Now here in profit and loss account there is no fixed place. The expenses which are given in the trial balance, only those expenses we have to record in the profit and loss account. So all the expenses and losses will be recorded on the debit side of profit and loss account, and all the incomes and gains we have to record on the credit side of profit and loss account. Now after recording all these expenses, losses, income and gain, we have to do the total of profit and loss account. Now assuming the credit side total is higher, now what we had recorded on the credit side, we have recorded all the income and gains. So if income and gains are higher and expenses and losses are less, the business is going to earn a profit, and this profit will be a net profit. Now this particular net profit we have to divide among both the partners. Now partner's name will be given in the trial balance. That partner's name will come in partner 1 and partner 2. We have to write down the name of the partner, and if in the problem ratio is given, we have to divide the profit as per the ratio, and if ratio is not given, we have to divide the profit equally among both the partners. Now assume profit is 10,000, and if we are dividing the profit 10,000 among both the partners equally, then for both the partners they will get 5,000 rupees each, which will come in the inner column. Now this we were not writing in the 11th standard, we were just recording net profit. But now onwards, whenever we get a net profit, we have to divide this net profit either in the ratio, and in the absence of ratio, we have to distribute equally among both the partners. So if credit side total is higher, that is income and gains are higher, expenses and losses are less, business is going to earn a profit, and that profit is net profit. Assume that if debit side total is higher, that is if expenses and losses are more and income and gains are less, then business is going to suffer a loss, and that loss is net loss. The same procedure we have to adopt, that is we have to write down name of the partner and we have to distribute this loss among both the partners, either in the ratio or we have to divide them equally. So a trading account is prepared to find out the gross profit or gross loss of the business. This gross profit or gross loss is transferred to the profit and loss account. Then with the help of profit and loss account, the partners comes to know whether he has earned a net profit or net loss of the business. Now this net profit or net loss will be finally transferred to the balance sheet. Now let us see balance sheet. Now first thing, balance sheet is not an account. Balance sheet is a statement. So balance sheet is a statement which shows the financial position of the firm. Now all the liabilities are recorded on the left hand side, whereas all the assets of the business are recorded on the right hand side. Now let us see the format of balance sheet. So as told earlier, left hand side we have to record all the liabilities, and on the right hand side we have to record all the assets. So all the assets which are given in the trial balance, that is whether it is a fixed assets or current assets, all the assets we have to record. That is whether it is land and building, plant and machinery, furniture, investment, motor vehicle, then cash balance, bank balance, a few intangible assets such as goodwill, copyright, patent, trademark. All these assets will be recorded on the right hand side, and there are few amount receivable such as bills receivable, sundry debtors will be also recorded on the right hand side, that is asset side. Now let us see the left hand side, that is liability side. Now students, liability side also we have to prepare in the same manner how we were preparing in 11th standard. The only difference is last year we were given only one capital. Now here we are solving partnership final account. So partners capital will be given, that is two partners capital will be given. So just see the format of balance sheet. On the liability side I had written as partner 1 capital. So first partner capital will be recorded. Then first partner, if it is a net profit, we have to add that net profit. If it is net loss, we have to write down less net loss. And obviously if drawing is given, we have to deduct the drawings. If any additional adjustments are given, that will come below that. So the first part is first partner capital, first partner net profit, and first partner drawings. We have to add or less all the amount, and then the final amount will come in the outer column. Then in the similar manner, second partner capital, second partner net profit or net loss, we have to add or deduct less drawings. All this amount will come in the inner column. We have to add or subtract the amount, and the final amount will come in the outer column. So instead of single capital, sole person capital, sole proprietor's capital was only one capital. Here partners capital, so first partner capital will come, his all personal profit, drawings, interest on capital, etc. will be added or subtracted from the first partner capital. Then in the similar manner we have to prepare second partner's capital, and below we have to record the remaining liabilities which are payable to the outsiders, that is creditors, bills payable, bank loan or bank overdraft is given, or undistributed profit is given, that is general reserve or reserve fund is given. So all these accounts are liabilities which will come on the liability side to do the total of assets and liabilities. Our balance sheet will always tally. So partnership final account is almost similar to the final account which we had seen in 11th standard, that is sole proprietor final account. The only difference is here partners are there, so two capitals will be given, two drawings will be given. The net profit or net loss which we calculate in profit and loss account will be distributed among both the partners. Either it will be distributed in the ratio or it will be distributed equally among both the partners, and then it will be transferred to the balance sheet on the liability side. So first partner capital, then his all personal net profit, drawings, all his adjustments will be recorded, and then second partner's details will be recorded. We have to add or deduct all the adjustment, and the final amount will be recorded in the outer column.